Hello and welcome back to the lesson. Today we are going to study the factors to consider when making financing decisions. And therefore, by the end of this lesson, you should be able to outline the factors that the company ought to consider when making financing decisions. Welcome to the lesson, candidates. And to start with, it's important to note that when making financing decisions, there are various factors that should be considered to ensure that the chosen mix of debt and equity align with the company's goals, align with the company's financial health and market conditions. When choosing the mix of debt and equity, because debt represents an external source and equity represents the funds provided by the owners of a business, equity capital and debt capital. That mix, the percentage of debt and the percentage of equity is determined based on various factors. What are the factors that a company should consider before deciding the equity capital should be say 60% of the total capital and 40% debt, or 70%, 30%, or 90%, 10%. What are the factors that ought to be considered? That is what we intend to discuss in our today's lesson. Factors. We want to discuss the factors that a company should put into consideration. Factors. The first one is cost. The cost of capital. The cost of capital. Cost of capital. Cost of capital is one important factor to consider. Cost of capital. The finance manager is required to evaluate the costs associated with different financing options, and that includes interest rates on debt, the dividends on equity, and the associated expenses like flotation costs and so on. And the goal here, candidates, in considering the cost of capital is to minimize the overall cost of capital. Cost of capital. Number two is risk tolerance. Risk tolerance. Risk tolerance. What is the risk tolerance? Consider the risk tolerance. Assess the company's risk tolerance and determine the appropriate level of financial leverage. Because different companies or different industries and companies have varying levels of tolerance for financial risk, and the chosen financing mix should align with such risk preferences. Like the banking industry may have, an industry may have a certain level of leverage, financial leverage, which may be considered as appropriate. Each different industries may have varying or different levels of financial leverage. So it's important to consider the risk tolerance. Capital structure ratios, number three. Capital structure ratios. Capital structure ratios. The capital structure ratio ought to be considered. Examine the key financial ratios such as the debt to equity ratio, the interest coverage ratio, in order to understand the current capital structure and the financial health of a company. So that a company that is highly geared, then it's not advisable to have a high percentage of debt within, additional debt within its capital structure. These ratios provide insights into the company's ability to meet its debt obligations and also its ability to manage financial leverage. Capital structure ratios, I've given an example. Interest coverage ratio, the debt equity ratio. Calculate such ratios before making any financing decisions. Market conditions. Number 4, market conditions. Market conditions. This is a factor to also put into consideration. Consider prevailing market conditions, consider the interest rate trends, consider the investor sentiments, and so on. Because changes in economic conditions or environment can impact the cost and the availability of capital. Consider market conditions. Next point is business life cycle. Business life cycle. Business life cycle of a company should also be considered. The stage of the business cycle candidates influences the financing decisions. For example, startups might rely more on equity financing. Startups. If you're starting a business, then most likely you may consider depending on the equity financing. While mature candidates may rely on a mix of debt and equity based on the established track record. So the business life cycle, we have matured companies, we have startups, we have businesses that are going through various stages in the business life cycle. We have there's something called the life cycle of a business. The same way we have life cycle of a human being. You start by being born, then you are a child, then you start crawling, then you will start walking, you are a mature person, you can stand on your own, both physically, both financially, emotionally matured. As you mature, you come to a stage where you start again losing strength, you're going down. So businesses also go through such life cycle. So when considering the financing decisions of a company, look at the business life cycle of the business. Then next point. Next factor is cash flow and earning ability, earning stability. Cash flow and earning stability. Cash flow stability, earning stability. Evaluate the stability of cash flows and earnings. A company with stable and predictable cash flows may be better suited to handle debt obligations, while a volatile business might prioritize equity financing. Volatile business means the earnings or cash flows are not stable. They are seasonal. It makes earnings or cash flows come in seasonally. There are fluctuations. That's a volatile kind of cash flows. Volatile, unpredictable. But there are businesses that have predictable cash flows, earnings, and so on. So for a business that has stable cash flows or earnings, such a business can handle debt obligations, whereas one that is not stable cannot handle such obligations, and therefore that is a factor to consider when determining whether to get debt equity or to get to finance projects of a company using debt. Regulatory environment. Regulatory environment is yet another factor to consider. Regulatory environment. Regulatory environment. Regulatory environment, the legal environment. Consider regulatory constraints. Consider regulatory requirements related to financing decisions. Why? Because there could be what the company may need to comply with financial regulations and legal obligations, which is crucial to avoiding legal issues and financial penalties. Regulatory environment. Another factor is dividend policy. What is the dividend policy of the company? Dividend policy. Dividend policy. If the company pays dividends, then its dividends can impact the financing decision. If a company has to pay dividends, right, then payment of dividend affects financing decision. In what way? Because in a way, the dividend policy affects, or dividend payments directly affects financing decision, because dividends are paid out of earnings, and earnings are sources of capital, is an internal source of capital. For example, a company that is committed to regular dividend payments may prefer equity financing to avoid a fixed obligations of interest payments. Do you understand? A company that regularly pays dividends may not afford to regularly again pay debt payments to service debts. So such a company would prefer just equity financing. Lastly, flexibility and adaptability. Flexibility and adaptability. Flexibility and adaptability. Ensure that the fixed obligation of interest payments, right? Ensure that the chosen, let me put it this way, ensure that when considering this factor, one has to consider, the finance manager has to consider, the finance manager has to ensure that the chosen financing structure provides the company with flexibility to adapt to changing market conditions or even business strategies, including unforeseen challenges, and therefore avoiding excessive rigid financing options is essential to ensure adaptability and flexibility. So these are 9 factors to consider when making financing decisions. And by carefully considering these factors, finance managers can make informed financing decisions that support the company's strategic objectives while mitigating risks and maximizing shareholders' wealth, maximizing shareholders' value, and so on. And finally, candidates, the optimal financing structure the optimal financing structure. An optimal financing structure is a structure that minimizes the cost of capital and maximizes at the same time shareholders' value. So the financing structure, this financing structure, the optimal financing structure, that is to say, may vary based on unique characteristics and circumstances of each business, because different businesses operate under different market conditions. They operate at different business life cycle. They operate within different regulatory environments. They have different risk tolerance and even capital structure ratios. So the optimal capital structure, the optimal financing structure, I'm saying candidates may vary based on the unique circumstances. May vary based on unique characteristics of each business. These are 9 factors that we sought to discuss before we began the lesson. The objective of this lesson was that by the end of this lesson, you should be able to explain the factors to consider in making financing decisions. And here is your question before we close the lesson. These are practice questions. Number 1, what external economic factors should be taken into account when making financing decisions for a business, and how might they impact the choice of financing options? Number 2, how do internal factors such as the company's financial health and risk tolerance influence the decision-making process in financing? Lastly, discuss the importance of timing in financing decisions and identify critical factors that organizations should consider in determining the optimal timing for obtaining funds. Thank you for attending the lesson. In our next session, we will study the sources of finances for enterprises, particularly with particular attention to internally generated funds and externally generated funds. In that lesson, we will lay bare the distinction between the internally generated funds and the externally generated funds. Bye-bye.